You see price push to a fresh high, hesitate for a moment, then buy because the breakout looks stronger than the last one. A few candles later, momentum fades, price slips back below your entry, and what looked like confirmation becomes a poorly timed risk. Here is the detail worth noticing earlier. When price makes a higher high, but RSI fails to make a higher high, the important information is not simply that the lines disagree. It is that price is advancing while the momentum behind that advance is weakening. In a hypothetical example, that does not mean you immediately short the market. Divergence can persist, disappear, or fail completely, but it can tell you that treating the new high exactly like the previous one may be a mistake. The harder question is why some divergences matter, while others trap you into acting too early. That distinction begins with what price is doing around the signal, not with RSI alone. You can spot a clean divergence on the chart, and still have no reason to trade it. The first question is not whether RSI disagrees with price. The first question is where the disagreement is happening. Imagine a hypothetical market moving sideways between clear support and resistance. Price makes a slightly higher high near the middle of that range, while RSI makes a lower high. Technically, you can draw a divergence. Practically, the location gives it very little weight because price is not testing a level where buyers or sellers have already shown meaningful commitment. Now move the same pattern to the upper edge of that range. Price pushes above a prior swing high, momentum fails to expand with it, and the move immediately enters an area where previous advances have stalled. The indicator has not changed. The context has. That matters because market structure creates decision points. Around prior highs, prior lows, range boundaries, and other visible structural levels, existing positions are being defended, new traders are entering, and trapped traders may be forced to react. If momentum weakens there, the divergence is appearing where a small change in order flow can produce a larger change in price behavior. By contrast, divergence in the middle of an active trend can remain visible while price keeps moving. A strong uptrend may produce a higher high with weaker RSI, then another higher high, because slowing momentum does not automatically mean sellers have taken control. If you treat every divergence as an isolated reversal signal, you can end up fading strength simply because the oscillator stopped accelerating. So make one concrete distinction when you scan a chart. Separate divergence at a meaningful structural boundary from divergence inside ordinary movement. Ask whether price is testing something traders can actually respond, a previous swing extreme, a range edge, or the end of an extended directional leg. If there is no important location, the signal may still be interesting, but it deserves less influence over the trade decision. This does not make divergence at structure reliable by itself. Trading remains uncertain, and location only tells you where the signal deserves attention, not whether the reversal will happen. That resolves the first filter, before studying the shape of the divergence. Establish whether it formed in a place that matters. The next problem is more technical. Even at the right location, are you comparing the correct price swings and RSI swings, or drawing a signal that only exists because you chose convenient points? A divergence can look obvious after you draw the lines, but the signal may depend entirely on which points you chose to connect. That is the problem. If the price swings and RSI swings do not represent the same structural events, the comparison has no clean meaning. Consider a hypothetical chart with 3 recent highs. The first high is followed by a deep pullback. The second high is only a minor pause inside the next advance. The third high becomes the next clear swing extreme. If you connect the first and second price highs, but compare them with RSI peaks formed during different parts of the move, you can create what looks like bearish divergence. The chart is visually convincing, but the measurements are not aligned. The mechanism is straightforward. RSI is responding to the momentum of price over time. If you compare one major price swing with one minor internal fluctuation, you are asking the indicator to compare 2 different types of market movement. That mismatch can produce a false impression of weakening momentum simply because the swings were selected inconsistently. So you need a repeatable rule before you draw anything. Compare a confirmed price swing high with the RSI peak that formed around that same swing. For bullish divergence, compare a confirmed price swing low with the corresponding RSI trough. Keep both points on the same time frame and avoid jumping between a large structural pivot and a small internal pivot just because the lines fit better. There is an important distinction here. A pivot that changes the visible swing structure is different from a small hesitation inside one leg. In a hypothetical uptrend, price may rise, pause for 2 candles, continue higher, then make a clear pullback. That 2-candle pause may create a small RSI peak, but it does not necessarily deserve the same weight as the later swing high that produced a meaningful retracement. This is where hindsight can distort analysis. Once price reverses, your eye naturally searches backward for points that make the divergence look clean. If you only accept pivots after seeing the outcome, you are no longer testing a signal. You are fitting the signal to what already happened. The practical resolution is simple: define what qualifies as a swing before judging whether divergence exists. Then compare only corresponding pivots under that rule. That will remove many signals that looked attractive at first glance. But even a correctly measured divergence leaves a larger question unresolved. If the momentum relationship is real, does it actually mean price is ready to reverse? Or can weakening momentum continue while the trend keeps advancing? Price can keep making new highs even after RSI has stopped confirming the strength of the move. That is where divergence is often misunderstood. The disagreement tells you that momentum has changed between comparable swings, but it does not tell you that control has already shifted from buyers to sellers. Take a hypothetical uptrend where price pushes from 100 to 106, pulls back, then advances to 109. RSI reaches a strong peak on the first advance, but forms a lower peak on the second. The second price leg still traveled higher, but it did so with less momentum relative to the earlier move. That is useful information because the advance is losing force. It is not yet evidence that sellers can drive price lower. This distinction matters because momentum and direction are not the same thing. A car can continue moving forward while slowing down. Price can behave the same way. Buyers may be less aggressive than before, yet still aggressive enough to absorb available selling and maintain higher prices. As long as that remains true, bearish divergence can persist while the trend continues. You can often see this on the candles themselves. The market may take more bars to cover less distance. Extensions may become smaller, or each new high may require more back and forth trading. RSI reflects that loss of acceleration. But if pullbacks remain limited and price continues recovering from them, the existing directional structure has not necessarily failed. So separate 2 observations when you analyze divergence. First, is momentum weakening? Second, has price actually stopped behaving like the existing trend? RSI can answer the first question. It cannot by itself answer the second. That separation changes the practical use of the signal. Instead of treating bearish divergence as an instruction to sell, you can treat it as a warning that a previously strong advance deserves closer observation. Bullish divergence works the same way in reverse. Weakening downside momentum may show that selling pressure is becoming less effective, but price can still continue lower. The payoff is precision. Divergence identifies deterioration in momentum, not a guaranteed turning point, and acting as though those are identical can place you against a trend that is still functioning. Once that is clear, the next question becomes unavoidable. What observable change in price would show that weakened momentum is finally turning into an actual shift in market behavior? Once divergence appears, the chart still needs to prove that price is responding to it. A lower RSI high beside a higher price high is information about momentum. Confirmation begins only when price itself stops behaving as it did during the advance. Consider a hypothetical bearish setup. Price makes a new high, RSI makes a lower high, and the market pulls back slightly. If price then immediately recovers and pushes higher again, the divergence has not produced a meaningful change in behavior. Buyers may be operating with less momentum, but they are still controlling the sequence of higher prices. Now change one detail. After the divergent high, price pulls back, attempts to recover, fails below the recent peak, and then trades through a nearby swing low. That sequence carries different information. The failed recovery shows that buyers could not restore the previous expansion, and the break lower shows that sellers were able to move price through an area buyers had recently defended. That is the cause and effect relationship you are looking for. Divergence warns that the existing move is losing force. A structural failure shows that this loss of force is beginning to affect actual price movement. The first observation creates attention, the second creates evidence. There is also an important distinction between rejection and confirmation. A long upper wick after bearish divergence can be useful because it shows that higher prices were not fully accepted. But one rejected candle is still a local event. If the market continues holding its higher lows afterward, the broader price sequence remains intact. A rejection becomes more meaningful when later price action supports it. For practical analysis, focus on whether price can continue doing what made the trend healthy. In an advance, that usually means extending higher and defending pullbacks. If extensions begin failing and a meaningful higher low gives way, the market is no longer behaving in the same manner. In a decline, reverse the logic. Watch whether lower prices continue to extend and whether lower highs remain protected. This does not make the reversal certain. False breaks occur, and price can regain lost structure. Confirmation simply means the divergence is no longer standing alone. Price has begun to provide independent evidence that the previous directional behavior is weakening. So the useful takeaway is clear: let RSI alert you, but require price to demonstrate the change. Once that change appears, another decision immediately follows. Do you act as structure breaks, wait to see whether the broken level is tested again, or risk watching the move leave without you? Once price has confirmed the divergence with a structural break, the next mistake is often entering simply because the move has started. Confirmation tells you the market has changed behavior. It does not tell you that every price after that change offers the same trade. Consider a hypothetical bearish setup where support breaks with a large candle. Entering immediately gives you exposure while downside pressure is visible, and that can matter if price continues without looking back. The consequence is that you may be entering after much of the initial move has already happened, when the distance back to the area that matters structurally has expanded. Now compare that with waiting for a retest. Price breaks support, rebounds into the same area from below, then struggles to regain it. The advantage is not that a retest is automatically safer. The advantage is that price gives you another observable decision point. If former support now acts as resistance, you have additional evidence that the break is being accepted. But waiting carries a different cost. Some breaks never retest. Price may continue moving, leaving no second entry. That is why execution is a trade-off rather than a search for a perfect trigger. Entering on the break increases the chance of participation, while waiting for a retest can improve the quality of the price you receive, but increases the chance of missing the move entirely. There is one distinction worth applying immediately. Separate an entry taken near the confirmation event from an entry taken after emotional chasing has begun. If the market has already moved several candles away from the broken structure, the original setup may still be valid, but your entry conditions have changed. You are now paying a worse price for the same idea, and the market has less room to move before reaching the next opposing area. That cause and effect matters because execution quality changes the shape of the trade even when the analysis is correct. A good trade entered too late can still create poor risk relative to the remaining opportunity. So choose the execution method before the break occurs. If your plan is to enter on confirmation, define what qualifies as confirmation. If your plan requires a retest, accept that some moves will leave without you. That resolves the entry question. The goal is not to catch every reversal, but to enter under conditions you can evaluate consistently. The next issue is more important than entry precision. What exact price behavior proves that the entire divergence setup is no longer valid? A divergence trade can look wrong for several candles without actually being invalid. Price may retrace, RSI may turn sharply, and the market may test the area where you entered. None of those events matters by itself, unless it damages the price structure that justified the trade. Take a hypothetical bearish setup. Price forms divergence, breaks a meaningful support level, and a short is taken after that structural change. The market then rebounds. If that rebound stalls below the broken level and sellers regain control, the original thesis is still intact. Price is testing the breakdown, not necessarily reversing it. Now change the behavior. Suppose price climbs back above the broken support, holds there, and begins trading as though the breakdown never happened. That matters because the setup depended on sellers taking control of that level. If buyers reclaim it and maintain acceptance above it, one of the central pieces of evidence behind the trade has been removed. This is why invalidation should be linked to price, not to an arbitrary RSI reading. RSI can rise during a short trade simply because price is bouncing. If you exit every time the oscillator strengthens, normal retracements can force you out even while the bearish structure remains valid. The indicator helped identify the setup. It does not automatically define where the setup fails. There is also a practical distinction between a temporary test and a genuine reclaim. A wick through a level followed by immediate rejection is different from several candles holding beyond it and continuing to build structure there. The first may be noise around the level. The second suggests that the market is accepting prices that should have remained rejected if the original thesis was still working. The same logic applies to the terminal swing. In a bearish setup, a clean move through the high that defined the reversal idea can invalidate the premise more directly. If price is making new highs again and sustaining them, the market is no longer behaving according to the scenario you entered. So define invalidation before the trade is opened. Ask which exact structural event must remain true for the position to make sense, then identify what price would have to do to negate it. That gives the trade a logical boundary instead of an emotional one. Once that boundary is known, another consequence follows immediately if the invalidation point is far from the entry. The amount of exposure you can take has to change. Once the invalidation point is defined, position size stops being a matter of how confident the setup looks. It becomes a calculation based on distance. The farther price has to travel before the trade is proven wrong, the fewer units you can hold if you want to keep total risk controlled. Consider a hypothetical setup where the entry is 100 and the logical invalidation point is 98. The trade has 2 points of price risk per unit. Now compare that with another setup entered at 100 where the structure requires invalidation at 95. The second trade may look equally attractive, but each unit carries more than twice the price risk. If you use the same position size in both, you are not taking the same trade risk. That is the mechanism traders often reverse. They decide how large they want the position to be first, then move the stop closer so the potential loss feels acceptable. But if the closer stop sits inside normal market movement, the position can be closed even though the original structural idea has not failed. Position size should adapt to the chart. The chart should not be distorted to justify the position size. A simple way to think about it is to define the maximum capital you are prepared to lose on the trade, then divide that risk by the distance between entry and invalidation. The exact calculation will depend on the instrument, contract value, leverage, fees, and account structure, but the principle stays the same. Wider structural risk requires smaller exposure. There is an important distinction here between a tight stop and a low-risk trade. They are not automatically the same. A tight stop with an oversized position can expose as much capital as a wider stop with a smaller position. What matters is the total loss if price reaches the invalidation point. This also prevents the divergence itself from influencing size emotionally. A dramatic-looking signal does not reduce uncertainty. If the setup requires more room, the position should shrink rather than assuming the pattern deserves more capital. So the practical resolution is clear: define invalidation first, define acceptable account risk second, and let those two variables determine size. That keeps the exposure proportional to what the market can actually do against the trade. Once the position is sized correctly, the next problem begins after entry: what price behavior tells you to keep holding, reduce exposure, or tighten the trade as the market develops. After entry, RSI can become a distraction if you keep treating every change in the oscillator as a new decision. The trade was open because price structure supported the divergence thesis. From that point forward, management should depend mainly on whether price continues to behave in the direction the trade requires. Consider a hypothetical short entered after bearish divergence and a confirmed breakdown. Price moves lower, then rebounds and RSI rises sharply. That oscillator recovery may look uncomfortable, but if the rebound stalls below the broken structure and forms a lower high, the bearish sequence is still developing. The market is retracing inside the move, not necessarily reversing it. The important mechanism is follow-through. A bearish trade should begin producing evidence such as lower highs, failure to reclaim broken levels, and continued pressure on nearby lows. Those behaviors matter because they show that sellers are still able to defend lower prices. If each rebound reaches less distance and each decline continues to extend, the trade thesis is gaining structural support. Now compare that with a different response. Price breaks lower after entry, but every attempt to continue is quickly rejected. The market repeatedly returns to the breakdown area and begins spending more time above levels that should have acted as resistance. That does not automatically require an immediate exit, but it tells you the expected follow-through is weakening. The trade is consuming time and risk without producing the price behavior that justified holding it. This creates a useful distinction between normal retracement and failed progression. A normal retracement moves against your position without repairing the structure that supports the opposing side. Failed progression occurs when price repeatedly cannot extend in your favor and begins restoring the structure you expected to remain broken. Management decisions can then respond to evidence rather than discomfort. If structure continues developing as expected, there may be no reason to interfere simply because RSI fluctuates. If the market begins losing follow-through, you may have a reason to reduce exposure or tighten your management criteria, depending on the rules of the strategy. The takeaway is that the indicator helps identify the opportunity, but price should govern the position once the trade is active. Hold because the market is still behaving correctly, not because RSI still looks attractive. Eventually, however, even a trade that continues to work has to be closed somewhere. That raises a different question. What should determine the exit when the market has moved in your favor? A divergence trade can move well in your favor and still be managed poorly at the exit. The problem usually appears when the trader keeps using RSI to decide when the move is finished, even though price has already provided a clearer objective. Consider a hypothetical bearish setup. Price confirms the divergence trades lower and approaches a previous swing low that has acted as support before. RSI is now deeply oversold. Exiting only because of the RSI reading may happen too early or too late, depending on how price behaves at that level. The more useful question is whether the market has reached an area where opposing order flow is likely to matter. That is why structural objectives are more practical than arbitrary oscillator thresholds. Previous swing lows, range boundaries, and established support zones matter because traders have already reacted there. As price returns to those areas, short sellers may take profit, buyers may enter, and existing participants may defend positions. Those actions can reduce the continuation that made the trade profitable. There is also an important distinction between reaching a target and losing the trade thesis. If price reaches a predefined structural objective and you take profit, that is a planned exit based on where the move was expected to encounter resistance. If price turns before reaching that objective and begins reversing the bearish structure, that is a defensive exit. The first responds to completion. The second responds to deterioration. You can also observe how price behaves as it approaches the objective. If bearish candles continue expanding and rebounds remain weak, the move may still have pressure behind it. If price begins compressing, repeatedly rejecting lower prices, or failing to extend beneath the same low, the reward for continuing to hold may be changing. That does not guarantee a reversal, but it changes the information available. So the exit should be planned around price structure before the position is opened, then adjusted only if the market gives clear evidence that the original path is changing. RSI can still provide context, but an oversold or overbought reading alone is not a complete exit signal. The takeaway is simply enter because the setup forms, manage because price develops, and exit because the market reaches an objective or invalidates the remaining continuation thesis. Once the trade is closed, one final question remains. Was the result caused by the divergence itself, or by the context, confirmation, execution, and management rules wrapped around it? After a divergence trade closes, the outcome can tempt you to judge the entire setup from one result. A profitable trade makes the signal look valid. A losing trade makes it look defective. Neither conclusion tells you which part of the process actually produced the result. The useful review begins by separating the trade into variables you can observe. Record where the divergence formed, the time frame, the type of structural environment, the confirmation that appeared, the execution method, and what price did afterward. The purpose is not to create a complicated journal. It is to prevent several different decisions from being hidden inside one label called RSI Divergence. Imagine a hypothetical review of 20 setups. Suppose the trades taken near established range extremes often produced clean movement after confirmation, while signals taken during persistent directional expansion repeatedly failed to develop. That pattern would point toward context as the variable worth investigating. Changing the RSI settings would not address the cause because the weakness appeared in where the signal was used. Now consider a different hypothetical result. The locations were consistent, but several valid moves occurred without entry because the required confirmation was so restrictive that price had already traveled too far before execution became possible. In that case, changing the market, context filter could make the method worse. The issue would be the execution rule, not the divergence. That distinction matters because poor review creates unnecessary complexity. If you respond to every losing trade by adding another indicator, another condition, or another exception, you can change several variables before identifying which one actually caused the problem. Then you no longer know what improved the process or what simply reduced the number of trades. A practical review therefore asks one question at a time: under which clearly defined conditions does this setup behave differently? Compare similar trades with similar trades. Keep the rules stable long enough to observe patterns and treat small samples cautiously because trading outcomes contain uncertainty and randomness. The takeaway is not to optimize divergence until every historical chart looks clean. It is to identify which specific conditions consistently deserve more or less weight, then adapt one rule for a stated reason. That leaves the final issue to carry forward once you can separate a useful warning from a complete trade decision. Which parts of the process should remain fixed, and which should be allowed to adapt as market conditions change.